Welcome to the B.F. Anderson Technical Report for August 11th. Usually we talk on this video about technical analysis, but I do think we need to take just a step back and look at something that's fundamental, which is return on equity. It's a measure of financial performance calculated by dividing net income by shareholders' equity. It's a very simple ratio, but I think it's important. And if I was on a desert island and I had one number that I could look at, it would be return on equity. What you really have to realize here is that when you take an ownership position of a company, you have an equity position. You're not lending money. You're taking an ownership position. What you're really investing in, if you really boil it down, is the management of the company. Do they know what they're doing? Can they run the business? Are they competent? And so when you look at a company's earnings that come out every 90 days, what we do is we look at return on equity, which is simply we just look at the net profits divided by the shareholders' equity, which is assets minus liabilities. So this is really important because a lot of times you'll look at a company and it can be deceptive because they'll have debt, say a pretty good bit of debt, a high debt to equity ratio. Well, if they're generating returns on equity that are substantially higher than the norm, then the management knows how to manage debt. So it really boils down to, does management know how to deal with the capital of the company, and are they efficient? So I did also want to talk a little bit more back to technical here about a bottoming process. So what I did is I went back to the bottom of the market back in, from the 2000 bear market. And you can see here that, the market started to form a low back in 02, 03. Actually, it turned up on March 10th of 03. So you can see here, you put in a low, you retested the low, but however, it really wasn't a very, significant retest. But by the time you got to over 50% of the trend strength, you could see where the market started to really take off. So let's take a look at another period of time. This was the 08 financial crisis. However, this one was a little different because you came down and you made a low and then you retested, but then you made a more significant low. So if you would have thought this was the low, it would have been better to wait for that 50% or more trend strength. Now, we're going to talk a little bit more about trend strength as we get through the video. Now, on our indicators, we continue to see very constructive pattern here. We've got that golden cross on the Nasdaq breaking out of a base. It does look like the bottom has been put in here, but we could retest, so we just have to be aware of that. This is the mid-cap stock. Same thing, golden cross breaking out above that base. Looks very good. New York Composite, same thing. Now, we haven't gotten the golden cross yet, but we are breaking out of a base. Here's the small cap stocks. Again, same story, looks very, very positive. Here is the S&P 500, same story, looks positive. So we're looking like the bottom may have been put in on this market. We had basically a 16-month bear market. Hopefully it's over. Now, on the aggression index, which is a ratio, very simple ratio, where we're comparing technology stocks, growth stocks, to defensive stocks, meaning consumer staples, you can see here it looks like we put in a double bottom here. The lower moving average is turned up and actually starting to make pretty significant new highs after making a higher new low. So the aggression index is improving. I think the most important thing to note here in our three economic indicators is the fact that the price of oil has broken down below the 200-day moving average. We're seeing some improvement in the financial stocks. Interest rates continue to move sideways. So in other words, if inflation was really going to be a problem, a long-term problem, I just can't understand how the 10-year Treasury note would stay at such a low level. Now, on new lows, we're seeing big improvement on the new lows. In fact, just the other day, we had only 18 new lows. Yesterday, we had 58 new lows. But what this is basically saying is that the sellers are starting to dry up. And the real next thing that's most important are the buyers going to come in. And it looks like they are. Here's a growth fund called the IPO Renaissance Fund. This is stocks that have gone public recently. You can see breaking out. The lower moving averages have turned up, and that's looking very positive. So a lot of good news. Now the trend strength. Here we go, 62.5%. This is the highest reading we've had since we made this low. So we'll have to see. Now this is on the Nasdaq. Then we have also the S&P 500, 62.5%. So we're above that 50%, looking very constructive. No guarantees, but it does look better. The VIX has really been coming down. We would like to see it, and it did. By the way, this is like a 5-day moving average of the VIX, but the actual reading was below 20. So the VIX is starting to show where volatility is really coming down. Now, on this has got to be a big concern. This is the yield curve. I mean, look at this here. I mean, this is quite a dramatic drop in the yield curve, which usually in the past has indicated recessions. So the market knows we're going to have a recession. Maybe it knows, maybe it doesn't. But also the thing I've learned about this in the past is that once the market knows there's a recession, it then starts to discount a recovery. Now, I did want to touch base on this particular indicator. This is the weekly Nasdaq. We're getting very close of crossing above that 35-week moving average. Remember the rule. We've got to get above that 35-week moving average for at least 2 weeks. And then if we look at the S&P 500, getting very close, same thing. So we want to see both the S&P and the Nasdaq get above that 35-week moving average for 2 consecutive weeks. We'll have to see what that happens. Also, I want to call to your attention the percent of stocks on the Nasdaq above their 200-day moving average. You can see here real oversold readings here. So much selling. Like here's the bottom in 09. This is the bottom in 03. So you can see here that usually the rule is once you get down this low and then cross back above 25%, which means 75% are above the 200-day. So seeing kind of a reversal in an oversold condition. Here we have the New York Stock Exchange, same concept. You can see how deep the reading got back here in 09. This was back during the pandemic. We came down and now we're bouncing up. So looking somewhat better. Now, let's talk about the top 5. These are just stocks that we're in our database that we think look attractive, not necessarily biased, but we do own this stock. I have to mention that. Now, this pattern is very interesting because what you've got here is where a big institution or several big institutions came in and gapped this stock up, and then we get what you call an ascending flag formation. This looks very constructive. We continue to own the stock. EQT, which is an oil and gas producers, kind of moving sideways, however, continues to make the watch list. Lantheus, which is healthcare, we're seeing a lot of healthcare opportunities, stays above that 10-day moving average. They came out and reported earnings. You can see the volatility in here, and also you got a kind of a big amount of selling volume. So I would continue to watch Lantheus. Scorpio Tankers, this is oil tankers, continues to look constructive above the 10-day. Kind of an interesting pattern. Now, last but not least, we do own this stock as well. This is a company called Shockwave. Very interesting technology. They announced earnings, came in that day. Institutions came in and bought 2 million shares. Stock normally trades about 660,000 shares. So this is way above. This is what we call a gap up. And so we gapped up on the earnings announcement, and now we're kind of getting a second gap up, which is very positive. We traded 1 million shares on this stock yesterday. They have a breakthrough technology having to do with angioplasty, where they're pretty much making angioplasty obsolete. It's a medical-related equipment company. I kind of would relate this to Intuitive Surgical, which was the Da Vinci system. So if you have any questions, please feel free to give me a call. Thank you very much.